I'm Emily Chang in San Francisco, and this is Bloomberg Technology. This hour, Uber reports its first ever earnings as a public company, but doesn't share a forecast for the current quarter. Shares sales up 20% in the first quarter, losses widening to $1 billion. We will have it all. Plus, Facebook shareholders press for more checks on CEO Mark Zuckerberg's power. We will bring you highlights from the annual investor meeting. And Disney's $1 billion Star Wars expansion is now open to the public, with record crowds expected at a galaxy now not so far away. We will give you a sneak peek. First, to our top story, Uber has reported its first quarter as a public company. Investors currently trying to digest the details. Shares went up, then went down, now back up 2.9%. The company, meantime, putting some meat on the bones in the call, giving us a little color, reporting $1 billion quarterly loss as expected, but among the largest of any public company. That's more than Lyft lost in all of last year. Lyft also reported a big loss in its last quarterly earnings report this year. Uber also didn't provide a forecast for the current quarter. The earnings call is currently underway. CEO Dara Khosrowshahi speaking about the company's advantage over its rivals.
Our platform model allows us to acquire, engage, and retain customers with a cost as well as efficiency and effectiveness advantage over our rivals, typically monoline competitors. These efforts are just getting started as we penetrate into a $12 trillion total addressable market.
Joining us now to discuss Bloomberg Tech's Mark Millian. So what is the standout here? Because we knew a lot of these numbers going into this. We weren't expecting any surprises, except for the fact that it looks like they're not reporting a forecast for the quarter.
Yeah, so they had reported preliminary results on May 13th, so none of this is really a surprise. It's all largely within the range. They ended up sort of on the high end of the range, so investors reacted marginally positive to that. Stepping back, you still have to think, wow, like they lost $1 billion in 3 months. That's a lot of money.
As did Lyft.
As did Lyft in last year. They lost that much money.
But they lost a lot of money.
They lost a lot of money in the quarter due to, for GAAP accounting, you have to add all sorts of IPO equity costs. And so we'll expect to see those in Uber's next quarter. So expect giant losses in the next quarter due to those charges. But on the call, yeah, they didn't offer forecasts. They didn't explain why, but they did sort of give some vague guidance on the call, which is still ongoing, to expect incentives paid out to customers to come down in the future as a percentage of revenue. They said marketing will come down in Q2, which investors liked, and that drove the stock back up in aftermarket trading.
Looking at some of the details coming out from the call, they're talking about international, targeting countries where they see a regulatory opening: Germany, Argentina, Japan, South Korea, Spain, Italy. That on top of what he mentioned, Dara Khosrowshahi mentioned about Uber being a bigger platform. And so any company that competes on one thing, Uber is going to be more competitive.
Yes, those were countries that had been closed to pretty much any of these types of Uber and their international competitors for a long time, and have only recently started to open up. Japan and Germany both have very, very strong taxi industries that have a lot of influence in the government, and so Uber was kind of locked out of those countries for a little while.
And of course, Lyft doesn't have an international business.
Right, they're just in Canada right now. But they have a bunch of international allies, and so there is that prospect that maybe somewhere down the line, though we don't think it's anytime soon, they will try to expand globally, but Uber is a much, much bigger business than Lyft.
All right, well, we did put a chart together here in the Bloomberg comparing Uber's losses to Lyft's, and this one, it looks like has the most recent numbers. Tell us what we're seeing here.
Yeah, so in the first one, we're looking at operating losses for both companies. It's a tremendous amount of money for both, really. But by any business measure, they're very loss-making businesses. Uber vastly more so because it's so much bigger and operates globally. And then the operating margins are also not good by most business standards. But Uber's looks slightly healthier. Lyft kind of has been growing faster in many U.S. markets partly because it's been spending so much on paying incentives to drivers and discounts to customers to use the service.
One of the interesting things that's different between the two companies is that Lyft on its earnings call said that this was the peak spending year. When I asked Dara Khosrowshahi about whether this was Uber's peak spending year on the floor of the New York Stock Exchange, he wouldn't give me an answer. And so how is that going to sit with investors over the next few quarters, given all of the uncertainty on top of the market volatility?
Yeah, it's a good question. I mean, Lyft thinks that it can gain a foothold in the U.S. and then just like kind of bring the cost down and not have to spend so much to gain market share. Uber is competing in a lot more places, and so they don't know what's going to happen in India or Argentina or some of the countries you had mentioned. Although Uber did say on the call just a few minutes ago that this will be the investment year, so maybe the implication there is that next year won't be quite as expensive of an investment year, but I don't think they want to commit to anything just yet. They want to test the market and see how much investors are willing to stomach.
Well, even though it was a bumpy IPO, they did raise billions of dollars, which they could now invest. All right, we're going to continue to follow the headlines from the call. Bloomberg Tech's Mark Millian, thank you for that update. Well, U.S. President Trump and outgoing UK Prime Minister Theresa May will discuss Huawei during a June 4th meeting in London. May will listen to Trump's concerns about the Chinese telecom as the UK makes an upcoming decision on 5G gear. This according to a UK official speaking to reporters ahead of Trump's visit. The UK government currently doesn't use 5G equipment made by Huawei, but it is used in commercial networks. Coming up, Facebook investors go after CEO Mark Zuckerberg at this year's annual shareholder meeting, but it doesn't look like he's going anywhere anytime soon. We'll discuss the results of the meeting. And if you like Bloomberg News, check us out on the radio, listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. Mark Zuckerberg's control over Facebook was the focus of this year's annual shareholder meeting. But unsurprisingly, efforts to check the CEO's power failed. Investors rejected all 8 proposals at Thursday's meeting, half of which were aimed at limiting Zuckerberg's power. These included proposals to change the company's dual-class voting structure and elect an independent chair. This, as Zuckerberg himself holds the majority of the company's most powerful shares. Joining us to discuss, Bloomberg's Kurt Wagner and Shira Ovide. Kurt, you listened to the entire meeting. Set the scene for us, including the words "Fire Zuckerberg," which were projected on the side of a hotel.
Yeah, there was also a group there that had a big kind of hot air balloon type thing with an angry face emoji on it. I spoke to some people who were in the room. I was not in the room, but they said it was tense. They said it was sober. And so I think, you could tell just by the questions that were asked and the statements that people made, there are a lot of angry people at Facebook right now and a lot of people who want to have more or better answers from Mark Zuckerberg and Sheryl Sandberg.
Now, Shira, investors asked Zuckerberg several times about the amount of power he holds over the company. There was one who asked a follow-up saying something along the lines of, "I'm asking if you should still be CEO or if you should step down." And he said, "We're limiting it to one question, moving on." So what do you make of, obviously these proposals were rejected, we expected them to be rejected, but also sort of the evasive nature of the answers?
I mean, in a way, Facebook is kind of in a no-win situation right now, that everybody is furious at them for a whole host of sins. One of the people who stood up to ask a question was asking why Facebook has banned her small business that sells hoodie sweatshirts that read "Men are trash," right? So it was that level of shareholder questioning from, should Mark Zuckerberg be a dictator over Facebook, and why are you blocking my hoodie business? And that just shows you the scope of anger at Facebook right now, from the sublime to the ridiculous.
There was one investor, Kurt, who tried to ask Sue Desmond-Hellmann, who is the independent board member on Facebook's board, what she thought of this whole thing.
Yeah.
She also sort of deflected. I mean, tell us about it.
They had to actually bring her up to answer the question. She wasn't, I think, on the stage at that point, and so they had to kind of make this whole special thing, like, oh, we want to ask Sue a question, let's bring Sue up. And the question was about, hey, you're the lead independent chair. Are you actually going to call a meeting of independent board members without Mark Zuckerberg there? Is that something you would ever do? Would you consider, trying to hold him to account by maybe making decisions while he's not around? And she basically said no, and she was pretty pointed about that. She said, this isn't something we're considering. We're happy with the structure as it is right now, and we feel that this is the appropriate setup.
Meantime, well, if she wanted to, could she limit his power?
Well, they say that, as the independent chair, I guess she would be the only person who he really kind of has to report to. There are some rules in the proxy that say she can, for example, call these special meetings of the independent board. But again, she says she doesn't want to and doesn't plan to. So for all intents and purposes, he kind of has run of the show.
Meantime, Mark Zuckerberg did answer many questions, including continued questions about what counts as speech that should stay up, what should come down. Take a listen to one of his answers there.
If the rules for the internet were getting rewritten from scratch today, I don't think that most people would want private companies to be making so many decisions by themselves about what constitutes acceptable speech or what people are allowed to say around elections, or especially in different countries around the world where we may operate but may not even have a large physical presence.
This as controversy continues to swirl around this doctored video of House Speaker Nancy Pelosi that Facebook has chosen to leave on the platform. YouTube has decided to take it down. Now, Nancy Pelosi herself has commented on this. She said this to KQED earlier.
Facebook knows that this is false. They know that this is false, and yet they've decided to go. Now, we have said all along, oh, poor Facebook, they were unwittingly exploited by the Russians. I think wittingly, because right now they're willing to put something on that they know to be false.
Shira, what do you make of that? Nancy Pelosi coming out swinging.
Yeah, I mean, it's harsh and maybe unfair, but I can understand her anger, right? There is this doctored video of her that has been seen millions and millions of times on Facebook. And look, the company did do things to sort of make sure that it got slightly less distribution in people's news feeds. It made sure to put a little tag on it that said, there's more information about this video, and linked to third-party articles that said this is a doctored video. It's false, but obviously millions of people have seen it, and some people have chosen to believe it. And so, I think Pelosi is sort of reacting to that episode that embarrassed her.
Kurt, what do you make of the fact that this is the issue that Facebook is digging its heels in on?
Yeah.
This is the piece of content that Facebook is saying, you know what? We know that it's doctored, but it doesn't truly violate our policies.
I said this, I think it was earlier this week or last week. I was like, this is a really good reminder that Facebook's policy actually does not mean they take stuff down just because it's fake, right? And this happens all the time. This is just a very high-profile example, so it's getting a lot more attention. But when Facebook does take stuff down, it's because the people who posted it might be misleading who they are. They're pretending to be in the United States, but they're really in Russia, stuff like that. They don't actually take it down just because it's inaccurate. And so this was just a high-profile example and reminder of that policy. And there's a lot of people who suddenly realize, wait, this policy might not be as great as we think just because now it has to involve.
Well, and also it brings back this question of, is it simply too much to expect? Is it impossible for Facebook to be the arbiter of truth for everything on its platform?
Yeah, I think it is. I think you think about, there's 2.4 billion people, I believe, on Facebook, monthly users. Are you going to stop every single person who goes on and says, hey, the sky is red? Are you going to stop every person who, misspeaks or shares a stat that's a little wrong? I just don't think that it is a feasible task right now, and they certainly don't want the responsibility of doing it as well, and so that's why they're asking the government to step in and help out.
Meantime, a new billboard has gone up in San Francisco from Elizabeth Warren saying, break up big tech. Text us if you want to join our fight. Of course, Facebook isn't the only company that she's talking about, Shira, but fairly bold to throw this up in the heart of Silicon Valley.
Yeah, right. Lots of people getting their pour-over coffee, looking at Elizabeth Warren talking about breaking up big tech. So obviously, her campaign knows what it's doing to get attention. And yeah, you're right. Facebook is not the only company that's part of her kind of policy paper about breaking up tech. That Amazon is certainly a prominent example, and Apple and others. So this is not a Facebook-specific kind of target.
But given that Facebook is such a large platform, and in a way, because of all the content that is on there, should they be in the position of being the arbiters of truth, even if we believe that that is impossible the way that Facebook is architected right now? And if Facebook was smaller or broken up into smaller parts, would that be a more realistic proposition?
I'm not sure. I think break up Facebook has become kind of this catch-all solution to this problem of Facebook, to any problem of Facebook. And I'm not sure it really solves the problems that people are articulating. Okay, so if Facebook gets broken up into baby bells, into Instagram and WhatsApp and Facebook, you still have multiple internet hangouts with more than 1 billion users apiece that are still going to have to make these difficult content decisions. And I'm not sure it gets much easier if you're dealing with individual companies with 1 billion plus users as opposed to one company with multiple products that have 1 billion plus users.
All right, Bloomberg Shira Ovide, Kurt Wagner for us. Thank you so much. Obviously, this conversation's going to continue. Coming up, President Trump, yet again, trying to undermine climate change science. What does it mean going forward for clean tech and sustainable investing? Facebook has agreed to power its Eagle Mountain data center in Utah with electricity from a solar farm being developed by First Solar. Cove Mountain 2 will generate enough power for 36,000 homes. The 122 megawatt solar project is set to open in 2020. In other Facebook news. Meantime, Silicon Valley's rocky history with clean tech investing has been well documented. Startups focused on clean energy resources were once lauded as a winning bet, but the sector's hype quickly fizzled. There's been a resurgence, though, of interest in clean tech investing as the Trump administration hardens its attack on climate science. This week, the New York Times reported the White House plans to create a new panel to downplay climate change and discredit legitimate science on the topic. For reaction, I want to bring in Abe Yokel, managing partner at Congruent Ventures, a venture capital firm that has raised $92 million to invest in companies focused on sustainability. So what do you make of the president's new line of attack? Not to necessarily attack, but to undermine.
I think that's exactly what he's trying to do. So this is an ongoing data point of unwinding many positive regulatory moves on the parts of previous administrations, not just Obama, but Bush as well, to be candid. The reality is that this is likely to have almost no impact on my investment focus or my results. However, it's a total disaster.
Well, there seems to be an increasing interest, whether it's from you or other investors, in sustainable startups because of Trump, in sort of reaction to Trump. What do you make of that?
I think that's exactly right. So what I would actually say is there are 3 separate groups here that are really galvanized by the fact that the Trump administration is not focused on understanding or believing climate science. There's broad scientific consensus that global climate change is real. And what we're seeing is, number one, from an entrepreneurial standpoint, most people in the Valley and elsewhere are very cognizant of the fact that there is, in fact, climate change. We're seeing it out here every day. Locally here, PG&E obviously is a longer story, but they have gone bankrupt as a direct result of climate change. And the entrepreneurial community is focused on this. We're seeing tremendous deal flow. The second group you just actually cited, which is Facebook and others, there are 176 separate corporate groups that have pledged to go 100% renewable over the next 15 to 20 years. And the third group, frankly, is states and even utilities, which everybody says is kind of a head scratcher. But the reality is, states now, there are 6 states that have passed 100% renewable standards over the course of usually 2045 to 2050, and even about a dozen utilities that have said that they will go completely carbon-free over the coming years. So the Trump administration's stance has in fact galvanized a tremendous amount of interest in this area. And then lastly, and perhaps importantly from a capital formation standpoint in my world, our investors, our LPs, the pension funds, the endowments, they are very aware of what is happening in climate, and they're actually very exposed to it. Real estate holdings, energy holdings, massive assets are now exposed over the course of the next 20 to 30 years to global climate change. And they're looking to folks like us to motivate both some real counterbalancing returns for them, but also to mitigate some of the risks that they already have embedded in their portfolio.
So stopping climate change is one thing, but making money is potentially another thing. And the chorus with clean tech is that all of these investors flooded into it and then it didn't have the returns. Can you make money?
The short answer is yes. There's a much longer answer we don't have time for today. But the short answer is that the fundamental economics, particularly in the energy sector, have changed dramatically. So just as a quick example, solar, to generate an electron with solar, a kilowatt hour with solar, costs about 4 cents for a utility scale solar project. The fully burdened cost to run a coal plant today is between 6 and 14 cents, according to Lazard, which does more business in traditional power than renewables. So this is not a biased group. In order to just operate a coal business without the depreciation and amortization, it's about 3.5 to 4 cents. So in other words, today, solar power is actually as cheap or cheaper just to produce than to run a coal plant. That wasn't true 10 years ago. The fundamental economics have changed, and the administration, no matter how hard they try, is never going to be able to put that back in a bottle.
So you closed the fund 2 years ago. You've made 20-some investments. Quickly, what's the thesis?
General thesis is global climate change is real, that there are almost no other venture firms focused specifically at the earliest stages because of, frankly, the last 10 or 15 years of investment performance, and that there's a real ability to return, have significant returns over the course of the next 10 to 20 years as an early stage venture fund. So early stage venture, not unique. Our focus, very unique.
All right, Abe Yockel, managing partner at Congruent Ventures. Thanks so much for sharing all of that here. Coming up, Uber's first earnings call. Wrapping up, Uber's CEO saying they have suffered some brand damage in the United States. That's going to take time to repair. We'll have more on that coming up. Bloomberg Tech live streaming on Twitter as well. Check us out there at Technology and our global breaking news network, TikTok. This is Bloomberg. Technology. I'm Emily Chang in San Francisco. Back to our top story. Uber shares up more than 3% after reporting its first quarterly earnings as a public company. Company's revenue beat its own predictions slightly and analyst estimates. The company's CFO said that while the ride-sharing market is becoming more rational, he won't hesitate to spend to protect Uber's position. Uber is losing a lot of money, more than $1 billion this quarter alone. Joining us now, Wedbush analyst Dan Ives and Mandeep Singh of Bloomberg Intelligence. So Dan was reading the headlines on the call in the break, and one of the things that stood out to me is Dara Khosrowshahi saying there is no magic lever. There is no one thing that we can do to get to profitability. You know, the implication there is that it's going to be a lot of things that sort of make up the piece of this whole pie. What is your take on the results we saw today?
Well, I agree with that. I mean, and look, and compare that to what we saw with Lyft, where they said this was a peak year of losses. I think navigating that's important because right now for investors, the focus is on growth, the focus on take rates and bookings. And the last thing you want to do is back yourself into a corner, talk about profitability levers. It's going to take a few years, and I think right now, you know, they're doing the right things. And at least this, I view this quarter as a step in the right direction, especially after what's been a pretty shaky start since the IPO.
Mandy, what is your take on this continued level of losses? And Nelson Chai, the CFO, saying this is going to be an investment year. They're going to continue to invest.
Yeah, and you know where they're investing. They're investing in the food delivery business. That's where they are very heavily subsidizing the drivers. You see that's why the take rates are coming down. And you can see the reason why. The average prices for food delivery business is much higher. You can probably scale it up over time, and that's the one that's most fragmented. Even Amazon invested in a company like Deliveroo, so you know that end market is pretty big, and I think that's what they're striving for here.
Dan, what is your assessment of Uber's ability to get to profitability? And you know, I asked him on the floor of the New York Stock Exchange if this was the peak spending year, as Lyft said on its earnings call, and he wouldn't commit to that. So how likely do you think it is that Uber gets to profitability in the near term?
Look, and I think that's the smart move, because when you look at Lyft, I think that's maybe something they regret saying, just because right away it puts that sort of mark up there in terms of what they could do from a profitability perspective. And right now, Uber's doubling down. They need to invest, not just in Uber Eats, Uber Freight, and autonomous. Look, I think in the next 2 to 3 years, better chance of me playing for Golden State Warriors than them hitting profitability. So I think in the next 2 to 3 years, that's kind of what I view as off the table. I think if you look 3 to 5, that's more realistic in terms of where they could hit. But right now, the focus on growth, and especially on international, putting a fence around their backyard and making sure that call it 90 to 100 million users continues to ramp, and they monetize it, especially on Eats.
All right, so I won't be seeing you at the NBA Finals tonight, Dan. You've just broken my heart. But Mandeep, Nelson Chai did say on the call that marketing expenses were going to start to go down. That's presumably welcome news, given that both Lyft and Uber have been spending heavily to attract new riders.
Yeah, and he called out the rationality in the price U.S. market. So basically, Lyft and Uber are not subsidizing the riders anymore. I still feel they are subsidizing the drivers. That's why Uber's take rates are coming down. But I think it makes sense, right? It's a duopoly. We have seen this kind of structure in online travel market with Booking.com and Expedia. And I think over time it's going to pay off in the sense that these guys at least can maintain stable take rates in the core ride-sharing business.
So, Dan, what are you looking for, over the current quarter, which, by the way, they didn't give a forecast for? What's next?
Yeah, but I think it's important on the call. They did talk about take rates and some other sort of metrics they're expecting to improve throughout the year. Right now, it really comes down to the take rate number. Can that start to spike back up? What bookings looks like the second half of the year? Do they monetize Eats? And when you look at Eats, especially the Grubhub, DoorDash, and others, there's definitely a lot of competition there in terms of pressure on take rates. If they can manifest and sort of get through this period, it's an execution story. And no doubt it's in the penalty box as the stock coming out of the IPO. Investors continue to grapple with the valuation, especially with no profitability, even with binoculars. But we believe as they execute, the sum of the parts story, the 100 billion plus valuation, you start to get a stock that maybe gets re-rated there when you start to look out the next 3-4 years. But it comes down to execution. That's why this is such an important quarter. But the next few are going to be laser focus of the street.
Dan, I'm looking at a chart here that takes a look at short interest for the biggest and most recent IPOs, and the short interest in Lyft is way higher than the short interest in Uber. What do you make of that?
Well, I think Lyft right away, because of the domestic ride-sharing situation, made it an easier target, as well as the timing with Uber coming out. And they shot themselves in the foot a little on their first call with not giving take rates, not giving bookings. And the shorts, they've essentially smelled blood in the water there, and that's why you're seeing that. I do think that's overdone. I think Lyft has improved maybe some of the communication they have, at least with investors, over the last few weeks. And I think that's gotten a little overdone, but no doubt, Lyft is in the investor penalty box, and I think that's going to be one next few quarters. They need to prove themselves for the shorts to cover, which is why there's so much more focus on a Lyft versus an Uber, at least where we are today.
Now, on the call, Mandeep Dar really played up this idea of Uber as a big platform that does many things, which means that, according to him, gives it a competitive advantage over a smaller company that does one thing. You could imagine he's talking there about Lyft. But isn't it also a good argument that one platform that does one thing very well could also be a really staunch competitor?
Yes, but again, in this business, in our two-sided marketplace, like Uber, I think it's all about scale and network effects. And the fact that they have 90 million plus riders and they're international, with so many 60 plus countries, I think it plays to their advantage if they can, show steady execution. To Dan's point, it all comes down to how you monetize that rider base over time, how is your driver retention, and if they can show improvement on those metrics, I think it clearly is an execution story, and that's where the parallels to Amazon make sense.
All right. Well, of course, we're going to continue to follow all the headlines as they continue to come out. Mandeep Singh for Bloomberg Intelligence, Wedbush's Dan Ives. As always, thank you both. Now, Bank of America sees China tariff risks to Apple already priced into the stock, reaffirming its buy rating and $230 price target. The analyst cites iPhones, capital returns, services, and new products as upsides, and says Chinese retaliation on Apple is low since iPhones are manufactured there. Earlier today, Wamsi Mohan, Bank of America senior analyst, joined Bloomberg Television to break down his call.
I think the important thing here is to look at what really China can do. And there are two ways in which China can retaliate. The first is a direct way in which they could ban iPhones. We think the likelihood of that is quite low. But the second, which is actually more measurable, is really to look at the data. And we looked at multiple different sources of data to get some confidence around what is actually happening on the ground in China. We do a very extensive survey, and the survey results actually show that the purchase intentions of Apple iPhones for Chinese consumers, and globally, as a matter of fact, are not very different, did not change much through this whole trade dilemma that we're going through. Secondly, when we look at what is actually happening to iPhone sales in China, we're looking that the inventory is getting continued to draw down, which is a big deal because as inventory trends continue to improve, which they should seasonally at this time of the year, we should start to see a pickup in the back half of the year. And lastly, when we think about what the App Store, which is quite an important thing for Chinese games, the trajectory of that has actually significantly improved from just up low single digits in January and February to up over 20% in the months of March, April, and so far in the first half of May. So we think that the trajectory that the data is actually telling us is much better than what people are worried about, and that's the worries are being reflected in the stock, but the data is telling us a different story.
Wamsi Mohan there, Bank of America senior analyst. Coming up, more than 20 million jobs have been created in the U.S. since the Great Recession ended in 2009, but there's still a massive talent gap in tech. How one company is finding and training untapped talent. Next, this is Bloomberg. The unemployment rate fell to its lowest level in a half-century last month, capping the longest streak of job creation in modern times. And yet, an untold number of tech jobs remain unfilled. In our Work Shifting series, we're focusing on one company that's not just working to fill those jobs, but diversify the rising tech force as it goes. Jacob Su, Catalyte CEO, joins us now from Washington. Jacob, thank you so much for being here. So Catalyte, instead of complaining about the pipeline, is actually trying to expand the pipeline and create its own. Talk to us about how exactly what you're doing works.
Yes, well, thank you, Emily. We're essentially solving the problem of the skills gap in the labor economy, right? Really by filling the gap for software developers. We're doing this by using AI to find individuals who have the unique cognitive ability that would predict for success in careers in software development. We then hire them, train them, put them through the equivalent of a full computer science degree in just 20 weeks, and then put them to work in teams delivering engineering services all over the country for our clients. What's unique about this model is that we're literally hiring people from all walks of life. We're talking about musicians and teachers, construction workers, truck drivers, and even doctors and PhDs. And we're proving that we not only can make them good developers, we can make them the highest performing and most successful developers, those proverbial 10Xers. And our clients win because now they have access to an affordable, diverse, predictable tech workforce that scales on demand, literally anywhere in the country.
So where exactly do you find these workers? I mean, how do you apply AI to people that you don't know necessarily exist?
Well, we're really looking for a broad cross-section of society. And again, we're looking for remarkable, exceptional people. And we found that they're all over. They're hidden in plain sight. So we actually ask people, we put ads out in places like Craigslist and Indeed.com and different jobs boards all over the country. And it basically says, become a professional software developer, no prior experience necessary, take a test. You then go to our website and you sign up, and you're directed then to an online assessment where within an hour and a half to 2 hours, we give you a decision.
Now, what's also interesting is that you pay them to learn. You will pay some of these folks while they are in the middle of their training. Explain that model to me.
Well, at the end of the day, it really comes down to we are putting our money where our mouth is. We've proven that this model works. So we as a company decided that instead of trying to sell this as a service right off the bat, we would actually put our money where our mouth works, and we invest in our people. So we literally pay people to take our training. So once you're accepted into the program, if you accept to join, you essentially join a training program. There's no money out of the pocket for the student, for the trainee. We actually pay them a stipend, typically while they're in the training program. And when they graduate on a Friday, they're hired on a Monday. They begin initially as apprentices for 2 years, and then they convert to permanent staff engineers after the 2-year apprenticeship.
Now, companies here in Silicon Valley are traditional tech companies used to looking for a very specific and stereotypical thing. You know, the typical graduate from Stanford University with a computer science degree who's generally male and wearing a hoodie. How receptive are Silicon Valley's traditional big tech companies to taking on unconventional talent from unconventional backgrounds?
Well, you know, that's what it's kind of silly. You know, I'm a product of Silicon Valley. I'm one of the natives who actually who grew up there and who's built a career there. You know, Silicon Valley, I think, has a lot of these conceptions wrong. In fact, I'd say most of the country, the job requirements that people have for software developers is just wrong. In the sense, if you think about the titans of the industry, the people who built the entire tech industry, most of them didn't go to college or dropped out of college. You know, they're the ones who actually built the whole industry. This industry, if you go back in time, was built by musicians and artists and hippies back in the day. So it's kind of silly that we're now looking for people who actually have this 4-year degree kind of programmer type of background. The reality is that the best performers, the highest performers, can come from anywhere. It's just a matter of can we actually get them through a program that quickly gets them on-ramps in these careers and gives them the opportunity to actually grow and learn on the job.
Now, you can't do this on your own. So what do you think companies like Facebook, Amazon, Apple, Google, what should they be doing to do their part as well?
Well, our vision really is that, you know, people from all walks of life can actually be the highest performing and the most successful. I think it begins first with companies recognizing that and frankly getting rid of antiquated hiring methods like looking at resumes, doing traditional job interviews. We've actually found that our approach to hiring essentially using AI to find people who actually have demonstrated ability and potential and then training them to do the work of the future is a much better approach. The economics are a lot better, but of course the intangibles like culture and retention and all the things that actually go to building the soul of a company, those are all things that are intangible benefits of this model of hiring.
All right, Jacob Shu, good to hear the work that you're doing, CEO of Catalyte there.
Thank you.
All right, still ahead, Tesla has received yet another negative analyst call. Can the electric car maker recover from the slump? We'll discuss next. This is Bloomberg. The blows just keep coming for Tesla. Barclays is the latest firm to slash its price target on the carmaker stock amid growing concerns about profitability. In a new note Thursday, analyst Brian Johnson warned Tesla may be relegated to a niche carmaker and reduced his price target to $150, citing weak U.S. demand for the Model 3. This just a day after Musk sent an email to staff pushing for deliveries to catch up to demand. Joining us to discuss, Bloomberg's Craig Trudell, who covers the auto sector for us. So, Craig, Musk also told employees that he'd be checking in with every region every couple of days to talk about places where they can accelerate. How are investors and analysts reacting to that?
You know, these emails have been, sort of an effort on the part of Musk to, on one hand, kind of put to rest the notion that that Tesla has a demand issue, but also to kind of rally the troops. They also, it's also just an attempt that hasn't gone over that well with the market. You did see a bit of a tick up the last time he sent an email to employees where he did kind of try to put to rest this idea that they have a demand problem. But he also sort of phrased these emails in ways to where he left out the fact that there's a lot of work to be done for them to have a great quarter. And the second email was a little bit more on the side of, we have work to do. We have to work through our deliveries issues and bring costs down in order for us to have a great quarter. So they haven't necessarily had the effect that some other Musk emails have had, where it almost sort of read in the past as though he sent these, wanting them to leak, in the sense that he was kind of, cheering people on and sort of giving his employees a sense that things were on the up and up and the company was doing well.
So, given that the analysts keep piling on, is this just a rough patch, or is this going to continue for an extended period of time, perhaps be fueled by Tesla's next report?
Well, the Barclays report was really interesting because Brian Johnson at Barclays has had this, the way he's put the sort of bull-bear debate with Tesla is red pill and blue pill, which I guess is a Matrix reference maybe. But these are factions that are very strong and just very bifurcated, where people have for a long time treated Tesla as a potential sort of tech company that has the ability potentially to make money that automakers are not familiar with. The red pillars, if you will, know that the car business is slim margins, that you don't make big money making and selling cars, and they've really sort of been cautious about the idea that Tesla will ever be, sort of sustainably profitable, and not only that, able to sort of generate cash and cover the obligations that they keep sort of adding to the balance sheet. So on one hand, recently when Tesla went back to the markets to raise some money by selling stock and selling some more convertible bonds that maybe would have looked in the past, been sort of looked upon fondly with Tesla, where people have been willing to sort of cut checks to Musk, thinking that down the road he's going to be able to deliver these great things. I think you've seen a little bit of a return to a focus on the fundamentals, the idea that cash generation has not improved in a meaningful way, and that this is a company that has a lot more debt nowadays, and some real questions about whether they'll be able to address that.
All right, well, we'll be watching to see if any new emails hit Tesla employee inboxes. Bloomberg's Craig Trudell, thank you. Well, Disney wants the Force to be with you. It's finally unveiled its wildly anticipated Star Wars Galaxy's Edge theme park at its Disneyland park in California. The 14-acre project is set at the time of the most recent films and has officially opened to the public. Our own Ed Ludlow got an early look inside.
The newest addition to Disneyland California may not be in a galaxy far, far away, but standing here in the first full-size Millennium Falcon ever built, it certainly feels like it. Called Star Wars Galaxy's Edge, the land has two main attractions. The first is centered around the iconic Millennium Falcon spaceship. The Smuggler's Run ride allows visitors to pilot the craft or man guns and attempt to smuggle goods across the galaxy. Then later this year, Disney will open Rise of the Resistance. They haven't shared any details beyond the fact it will mimic a fight with the First Order, and it will open by the end of 2019. Fans can also build their own lightsaber or their own droid, but neither come cheap. The lightsaber will cost you $200 and the droid $100. Galaxy's Edge is Disney's biggest ever parks expansion, and the park segment accounts for more than 40% of Disney's overall revenue. And it's becoming more important at a time where Disney's most profitable business, TV, is losing viewership. Disney invested more than $1 billion in the Anaheim land and more than $4 billion across parks in 2018. I spoke to Disney's chairman for Parks, Experiences and Products, Bob Chapek, and he says that investors should expect that kind of investment to continue.
Walt Disney said that Disneyland would never be complete as long as there's imagination left in the world. And you couple that with the ambition of Walt Disney Imagineering, And I suspect that this is a new high water mark, but it certainly is not the end. This is just the beginning.
Disney bought Lucasfilms and the rights to Star Wars in 2012 for almost $4 billion. The gross receipts from those films have totaled almost $5 billion. Disney also hoped that the Galaxy Edge parks will drive further sales for merchandise. But the Star Wars franchise has had less traction in key markets like Asia and in particular China. Even so, reservations for the land in California sold out within 2 hours. Bloomberg Intelligence expects the force to be strong with Disney, particularly with parks revenue when it reports third quarter earnings in August. Ed Ludlow, Bloomberg News in Anaheim, California.
Can't wait to visit. That does it for this edition of Bloomberg Technology. We'll see you back here tomorrow. This is Bloomberg.